I'd like to welcome everyone to the main event, okay? The rise of the global IPO in among tech-enabled companies. I'm Robert Atkinson. I'm the president of Maine. And before I turn the floor over to our host and moderator, Arina, I do want to thank our sponsors. In fact, if you take a look here, Blancro, Marix, Murray, Concertive, Solidus, BW Cyber, PKF O'Connor Davies, Citron Cooperman, DMA, and our most recent sponsor, Fox Rothschild. So I want to say thank you. I also just want to say a word or two about Maine, okay? There's really three audiences that we've targeted, and our goal here is to facilitate the successful interaction of these groups. The first group are startup, small, and emerging managers, okay, as well as the issuers of digital assets. A second group includes investors who would place capital in these organizations, such as family offices, pension funds, endowments, and smaller institutions. The third group are the service providers who support these organizations. Okay, very important to us. And I do want to say that these organizations, our sponsors, are very critical to our ability to put events on like this, as well as the podcast that we do from time to time. And we're also very interested to hear input from members of the audience in terms of what you think is important. So by all means, please let us know. So on that note, I want to turn the floor over to Arina Shulga and just say thank you again to our latest sponsor, Fox Rothschild. Thank you so much.
Thank you. And welcome to Fox Rothschild. So first, I think we should introduce ourselves, and then we'll dive into our discussion. And just want to say, please speak up. I don't want this to be kind of a one-way presentation. This is the last thing I want. I want actually to learn from you all, right? We'll share what we know, but then you probably know more, just as much or more than we all do. So definitely collective intelligence, that's what matters, okay? So I am a partner here at Fox Rothschild. I'm a corporate partner, and I do kind of focus on two primary areas. First is the investment funds. I work on fund formation. I work on all matters that arise related to after the funds are formed. Mostly private funds. Well, actually only private funds, VC funds, and private equity, right? So I do a lot of SPVs, and we'll talk about SPVs a lot today. And I also do buy-side M&A transactions, like roll-up transactions for private equity clients. So this is me, and Fox, just a couple of words about our law firm. 1,000 lawyers, national firm, 30 offices from coast to coast and in the middle, we truly cover the United States. 70 plus practice areas, so full service. One of, MLaw 100 firms, and well, welcome again, and come back. Now, please, Jeff, introduce yourself, and then Chris.
Hi, I'm Jeff Stewart with the Global Public Offering Fund. At heart, I'm an entrepreneur. I started several businesses, and my first business, we merged, we went public. The second business I started didn't, and I noticed that it seemed like nothing was going public. So we really started our fund out of the frustration of seeing our investments and our companies not going public. And the epiphany happened as we were doing a lot of business outside the U.S., and we noticed that there was a huge appetite for fast-growing technology-enabled startups, and that the U.S. had become a mega-cap market. These other markets, we'll say, had size-appropriate regulation and frameworks for moving public. So in 2018, we launched the Global Public Offering Fund with the idea of investing in high-growth businesses that have founders that do want to move into the public market and have business models that are expanding globally, and we think will eventually be good public companies.
Hi everyone, I'm Chris Mayo, Head of Primary Markets in the Americas at London Stock Exchange. My background is in investment banking. I've actually been in New York most of the time since 1999 and spent most of my career with first Solomon Smith Barney, and then that became Citigroup Global Markets. And just to prove that I'm an investment banker by background and spent my time proofreading and looking at presentations, there's actually a typo there in my email address. I think it's actually lseg.com. You can always find me on LinkedIn as well. So I've got a lot of background in doing IPOs in different jurisdictions. Like I said, I've been in the US for a long time, despite my accent, and I've done IPOs in the US, UK, Sweden, Russia, Poland, and a number of other countries. So I know how it works in different jurisdictions. And now, 9.5 years ago, I took on the role of encouraging US companies to list in London. Well, it's the entire Americas, but it's mostly US and Canada I work on. And the thesis kind of goes to what Jeff was just talking about. The environment for going public and the cost of going public is very different in the UK than it is in the US, and we can talk about reasons why that is, and also what kind of profile we see in the UK and how it's different from a process perspective during this panel. Just to step back and talk about London Stock Exchange in the US, you may not realise it, but we're actually very large in the US. We have an office downtown near NYC. We're close to 2,000 people. They're not doing what I'm doing. We actually own businesses you'll be familiar with. So we own Russell. So the Russell 2000 is our product. And we also own Refinitiv, which is the main competitor to Bloomberg and was previously the Reuters financial data business. So investors in the US are familiar with our product, and other market practitioners are familiar with our products on a day-to-day basis, and we're systemically very important in the US as well, even though our name is the London Stock Exchange. Maybe we should change it to Global Financial Data Corp. Anyway, I'm really pleased to be here, and I'll be happy to take any questions that you have.
Great, thank you. Okay, so let's start from the beginning. Let's start with the reasons why we're even talking about IPOs and global IPOs. And for me, the reason is that we're actually, all of us, or most of us here, right, work with investment funds, right, investment vehicles. Even, Maine stands for Manhattan Alternative Investment Network, so it's all about kind of investment vehicles, right? And typically, obviously, when investors invest into such vehicles, they at some point want their money back, right? And so then they can take that money and invest somewhere else, right? So what is happening on the market now? What are you seeing in terms of like traditional exits? And by traditional exits, what do I mean? Well, we have M&A, right? That's always an acquisition. That's a great exit. IPOs, we'll talk about that. And then what else? What other exits are you seeing? So what's happening on the market from your perspective?
Well, we're not seeing a lot of IPOs. In the 80s and 90s, there were hundreds and hundreds every year, and a lot of them would be just raising under $50 million. So companies like Oracle and Adobe were sub $400, $500 million when they went public. That would be not appropriate for the U.S. market today, because the U.S. has become a mega cap market. Decimalization had a huge impact. Reg FD, there were a whole battery of regulations. So what we're seeing is companies staying private forever, and we see that the problem that causes, and we've seen it from the inside, is makes it harder to do acquisitions, makes it harder to attract talent. It creates a brittle capital structure, and it's very easy to get misalignment on your cap table, where one investor just wants to put more money to work because they're earlier in their life cycle, and another one just needs to get money out because they can't raise another fund until they show they can return capital. And all of a sudden, you're running a business because of the needs of your investors instead of creating equity value. That was one of the reasons we started the Global Public Offering Fund, is because we knew that these companies are exceptional companies, and there'd be strong demand for them by listing globally. And when we say globally, we really look at an IPO as a multi-jurisdictional undertaking, where you you target investors from all over the world. You don't just throw it over the wall and hope people find it.
Okay. So, Chris, what
Yeah,
are
I
you
think,
seeing?
I mean, let's say, I
terms
think
of
me moving here from the UK in '99 was actually an interesting point to come here because IPOs for smaller companies were still happening. Obviously, at that moment, we were kind of right in the dot-com boom and then crash. And one of the things that came out of that, and also WorldCom and Enron, was additional regulation in the US. So Sarbanes-Oxley came in, I think, in 2002. And that really changed the cost structure and litigation, kind of liability kind of environment for companies looking to go public. And if you actually look at the data, you can almost immediately see a change in the size of company in the US that was going public from a market cap or revenue perspective. And if you're nerdy enough to care, to look at this more in detail, there's a professor in the University of Florida called, I think it's called Jay Ritter, I think it's called the Warrington School of Business. He has a data set going back, I think, to the 70s on companies that have gone public in the US and their size at IPO in terms of market cap, offering size, free flow, revenue. And post Sarbanes-Oxley, you see a change. Really, it's like almost a step change, and that line has continued to go up ever since. Because cost was originally the main driver, and it's very interesting actually. If you saw President Trump on Monday saying maybe we should consider a move away from quarterly to half-yearly reporting. Again, that is a discussion of the inherent cost of being a public company in the US. In the UK, by the way, we have half-yearly reporting, not quarterly reporting. It is a lot cheaper because we don't have Sarbanes-Oxley. We don't have the same litigation environment. So we haven't seen that change in the size of companies going public. So as an example, last week, there was what we call an intention to float, so an intention to IPO announcement from a beauty technology company, whose main revenue market is the US. Their reported valuation is about $500 million with probably $20-something million of EBITDA. That kind of company, if it was a US-based company, would not consider going public in the US anymore. 25 years ago, they definitely would, and that's a change that's happened. I think as a result of that, there's another change that's happened is the cost made companies shy away from doing it, but it also meant the investor base moved away from those kind of companies as well. So if you go to most mainstream investors in the US, they will tend to now focus on companies certainly 2 billion above and likely 5 billion and above because they'll have liquidity thresholds which will say companies below that level are just not the kind of companies we want to invest in from an ability to exit in the public market. So you've got both an investor problem and you've got you've also got a regulation and cost problem. I think the other thing to say is that one of the positive things to say is there's obviously been a huge increase in the availability of private capital in that time as well. So a lot of companies don't want to go public because there's such an availability of private capital, but the point we're sitting at today is that people are desperate for liquidity. They're trying to get out of these investments, so they're looking at IPOs. Well, that's hard to do unless you're very large in the US. M&A, again, that's been more difficult in recent times. Private secondaries, as an example, LSE has just launched a private secondaries market, like NASDAQ private market. We launched that last week, and it applies for US companies investors as well, I hasten to add. And also de-SPACs as examples. So there's all these different ways people are just desperate to get liquidity. And to what Jeff has said and what I say is that in the UK, if you're, say, $100 million to $2 billion of valuation, we can do those IPOs all day long. In the US, people don't want to do those IPOs for the reasons that I've talked about.
I would also add continuation funds. So people are raising funds just to buy the previous funds, kind of to provide liquidity for their investors, and I am personally also seeing a lot of secondaries funds. Sometimes I work on, multiple SPVs per week. They just create. Why? Just for the purpose of, sometimes it's even a multi-level structure, right? To invest into the shares, hopefully, of a portfolio company. which sometimes doesn't work out, right? Because there is a lot of uncertainty. Because who is selling in secondaries? You know, who are those people? You know, the founders who want to exit, so it's common shares. Employees, early employees, who finally get, you know, hope to get, you know, some liquidity. Then maybe early seed funds that have invested like in early stages, early rounds, that for them it's already time to, terminate their fund and definitely exit. There's a lot of pressure there. Maybe some growth funds that maybe have shifted their investment focus, or maybe they just want to sell some of their portfolio, right? But these are the kind of the people, entities that are selling in the secondaries market, and they're selling back to, you know, other investors. So they're really not creating any value, any additional anything. It's just like a recycling of capital.
Yeah, focusing on continuation funds, I think what I'm hearing is that the argument is, oh, these are our best assets. We want to keep them. But the feedback we're getting from some investors is that it's the ones that can't sell, and they don't want to acknowledge that they're not really, that they overpaid. So you really need to be very sophisticated to decide whether to stick into a continuation fund or not, because you really need to do analysis of the underlying companies. But the problem with continuation funds is you're pitting investors against each other. So you, as a GP, I have some LPs. I do a continuation fund. 5 years from now, half those LPs are going to hate me, because they're going to be like, "Oh, you should have kept me in. You're like, why did I leave? And I made the wrong decision. You didn't give me enough information." So you're I think investors, I prefer not to give stock tips, because if people make money, they think they're brilliant, and if the stock does badly, they blame me. And I think this is the same thing that's going to happen with continuation funds, is that GPs are going to have eggs on their face, because they're not everyone's aligned.
Yes. And are you seeing this activity in certain sectors? Like, for example, obviously AI is on everyone's mind, and I don't know how everyone feels, but I feel that some of the companies are really hyped. Their price, their valuation just keeps going up and up and up, and I was like, okay, how where is the ceiling? If there's one, I don't know. And then any other sectors that you feel like being hot?
I think I'm seeing more continuation funds in private equity as opposed to venture.
Okay.
But I think in venture I'm seeing more SPVs. But I'm just seeing a piece of the market.
Yes.
I think on SPVs, it's crazy. You have SPVs that are parts of other SPVs. There are parts of other SPVs that don't actually have the stock. The stock is subject to a ROFR. So in theory you'll get the stock someday. But have you really looked the ROFR over carefully, and do you know how your other shareholders are going to behave? So I think the endless SPVs are very lucrative for insiders, but I don't know that that's also going to be popular 10 years from now.
Chris?
Well, and like I say, I'm primarily an IPO guy, and looking at the IPO, there's been a lot of news kind of headlines recently. IPOs are back, and I actually don't see that so much, because the type of IPOs that have happened in the US this year have not been, what we call traditional VC IPOs. So Figma's probably the only one where you can say that's a kind of traditional VC-backed business. There are a lot of SaaS-type businesses sitting in VC portfolios, and they've not been going public. The ones that have been going public are crypto or AI related.
Okay, yes.
That's really where you've seen the activity. And the thing about both of those, they have a hook where retail investors want to get involved. So retail investors have been driving a lot of that activity. I think that's one of the things that's really changed about the US market. Certainly is different than most other markets around the world, is retail as a level of participation is far higher in the US than it is in other countries. And they really do drive a lot of the demand for and certainly the immediate trading in the aftermarket. We certainly saw that with Figma, where it priced at 33, opened at 85, traded up within 2 days to 140, and is now at 53. So we see a lot of the activities are really about creating froth, if you like, that retail investors are going to kind of chase after. But still, if you look at VC portfolios, very few of those companies have gone public in the last couple of years. Even though we're getting positive headlines about IPOs, there actually aren't that many.
Yeah, but the world could support a lot of them.
Yes.
You have hundreds of millions of people moving into the middle class in emerging markets, and most of the wealth is not in the U.S. Most of the investors are not in the U.S. Most investors have access to the market 24 hours a day on their phone.
Mm-hmm.
So you're seeing a cohort of younger investors who are interacting with the exchanges through their phone, and that's a factor I don't think has been fully priced into the future yet.
So that's interesting. So you're actually suggesting that for U.S. companies to actually go and do an IPO somewhere else,
Exactly.
it could be an attractive opportunity that people are just kind of not considering. Or maybe
Yeah.
are considering, but really not talking about this.
Yeah, I think,
right?
but it's
Exactly.
for a certain size. I mean, if you're a Figma, you'll get the demand in the US. People will bite your hand off, and I understand why. I understand why a company like that would go public here, but there are lots of really good companies which are in the like 100 to maybe 2 to 5 billion, who mainstream US institutions would probably turn their nose up and say it's too small. Whereas, as an example, I'll give you, just think about how the size works as an example. $1 billion market cap company, so that would be a unicorn going public. In the UK, that company would be in the top 300 companies by size ranking. In the US, it would probably be 2,500. It's completely different kind of perspective from size. And so the market is more focused on companies of that size. And to Jeff's point, you've got all these people around the world. In a lot of countries, people are essentially digital first in everything they do, be it banking or investments. They're investing in crypto. They can be investing in these kind of companies as well through an app on their phone, and that they are savvy about financial instruments, and this just creates a huge opportunity. And by the way, these companies in this size at the moment do not have a public market option to them in the US. So that's the point we're trying to make.
We had a U.S.-based company that was looking to list in Australia, and they couldn't. They were going to raise under $100 million, just under $100 million. No U.S. institution was going to talk to them, a public market institution. But the same institutions had analysts in Singapore who met with them, right? So they had analysts in Australia that met with them. So you can actually get access to U.S. institutions. You're just dealing with a different portfolio manager, a different analyst. And then there's enormous amounts of capital being actively managed. And then there's passive. Half the market is passive capital. You're included in an index much earlier, to Chris's point.
Yeah.
I mean, there's $400 million market cap companies that are parts of major indexes in other parts of the world. And you can do that as a fast-growing company. You're going to stand out. Like say you're the tallest flower in the garden there, where you just lost here in the U.S.
So when we talk about markets, which markets are we talking about? Like where could a U.S. company go and do an IPO?
Canada, for example?
Canada?
Yeah.
Okay.
Especially now.
Well, London.
Maybe London?
Yes, okay. Where else? You mentioned Australia,
Yeah. So
Hong Kong. I don't know.
Our view is the exchange is part of your stack in the same way that being incorporated in Delaware is part of your stack, and maybe your intellectual property is in Ireland, that's part of your stack, and your development team might be in Budapest. So the exchange is just one piece of the global investor base. So we call it going public globally, because if you're going public in Canada, you still might be courting an investor down in Brazil who's really knowledgeable about your space. So I think it's I like common law and law that is kind of derived from common law. So I think for our fund, we would be encouraging a listing in an exchange that's derived from common law. But it really depends on the company. I mean, if if you're a CEO and you have connective tissue to Japan and you're doing a lot of business there, that might be part of your listing choice.
Yeah. So I think it's, Jeff kind of hits the point there. I think, TSXV, which is a venture exchange of TSX, does very small IPOs. Typically they're reverse takeovers. They're called capital pool companies. That's if you want to raise a couple of $1 million relatively cheaply and quickly. TSXV has got a very kind of streamlined way of doing that. I think the issue in Canada is sometimes is the follow-on capital there when you want to raise more money to grow. In the UK, we've got AIM in the main market under the LSE umbrella. AIM is a bit like TSXV, but it's got more institutional investors, and there you can tend to you can raise more money, and also it's more easy to raise follow-on capital on an accelerated basis as a, say, I don't know, 50 to billion dollar company. That's where we spend most of our time on AIM. But ASX in Australia, really strong pension system that really underpins that market. I mean, for all these markets, there's been companies that have gone there, then got larger, and then been able to come back to the US when they're large enough to deal with the, the obligations of being a listed company here, and also get investor interest. So for these markets, they can be a stepping stone back to the US when you're large enough, but it's just an entry level into high quality institutional capital, earlier stage, and at lower cost. And the last thing I was going to say is, it really is which market fits you the best. So, for example, I've seen companies that do, from Chile, that do salmon fishing, and they're listed in Oslo, because investors in Norway have a lot of knowledge about seafood. So the Oslo Stock Exchange will go meet them and say, yeah, we're good at oil field services, and we're the premier seafood stock exchange in the world, which is quite an interesting take.
Isn't the mining sector a good example of what you're talking about, where a company could be domiciled in the United States, run by Canadian engineers, listed in London?
Well, I've got an example of exactly that. So there's a company called Pulsar Helium. Their assets are in Minnesota. They're a Canadian incorporated company, and they were listed on TSXV. They added London listing last year and raised further capital. So that just gives you an idea of kind of how this can all fit together.
You mentioned before, I think, crypto and digitization.
Yeah.
Do you see that as maybe solving for some of the issues that we have here in the United States? Because my recollection, I was here 25 years ago, and I recall the regulatory changes. I mean, we used to have 10,000 public companies in this country. Now I think it's less than 4,000. Now that money didn't evaporate, as you pointed out. It went into the FANGs, et cetera, et cetera. But there's still money on the side that went into private equity, right? Mm-hmm. So what you're talking about, how do you monetize? How do we get out of that, right? And so there are only so many companies that can be bought by Amazon, right, or go public. And that leaves the rest of them. What do? How do they exit, right? So my question is, do ATSs, at least in theory, maybe solve for that or part of that issue? And is it liquidity at the end of the day? These 100 million cap companies we're talking about, 200 million $1 million cap companies, isn't part of the issue liquidity?
Liquidity is a huge part of it. But I think what you're going to see is specialization. You'll see some exchanges specialized by size, and you'll see others specialized by industry. And companies will target investors based on who they think the right investors are for them. So I think you're going to see, especially like AI, is going to help find companies that meet your criteria. AI is going to drive down the cost to analyze a company. So all of a sudden you can do analysis on a $200 million company, which you can't do if you're going to throw $1 million a year analyst at it. Like you can only spend so much time if you're only going to put a little bit of money to work. But AI changes that.
What about smart contracts? Do smart contracts play a role? Let's say you're an LSET guy. Yeah. So you're into the world of collateral, right? Yes. So one of the reasons we have to put collateral when we do these transactions is we're unsure of settlement, right?
Yes.
So as we come closer to point of sale transactions, that issue should be mitigated, right?
So lots of things to talk about there. Let me try and go through them in some form of order in the way that you asked. First thing you asked about ATSs. So And I think you were really talking about private secondaries.
Yes.
Okay, so they're not ATSs. So NASDAQ Private Market is not an ATS. NASDAQ Private Market is actually a broker-dealer. They are essentially doing a book build with the company stock or some employee stock with investors. So they're not licensed as an ATS. So we're launching a platform where we won't be the broker-dealer, but we'll have other broker-dealers feeding into it. They'll use our technology to do the auctions. But in the US, to do those private secondaries, you don't need to be an ATS. You just need to make sure there's a broker-dealer somewhere in these transactions, because that is the regulatory requirement. In the UK, to do them, you need to be a licensed operator, and we are. NASDAQ Private Market is not in the UK to do those deals, so we can do the deals in the US and in the UK for private secondaries now. Now, you also talked about digital infrastructure. I think that, and you mentioned we own LCH, which is the biggest clearer of interest rate swaps in the US. So I think there is a lot of work that can be done on smart contracts with regards to more complex assets where, you know, certain conditions need to be met, the collateral needs to go there, and then automatically the transaction can complete. I don't think at the moment that for public equities that certainly blockchain infrastructure at the moment has enough throughput to be able to do those kind of deals. So we actually did our first digital market infrastructure deal last week, where we tokenized an investment fund, and basically one LP sold a fund interest to another LP, and it was tokenized. Mm-hmm. So for more illiquid assets where there is more conditions that need to be met, I think that digital smart contracts and digital infrastructure works best. I don't think it works so well at the moment for things which have incredibly high volume, like just regular equities. But in the future, could that change? Absolutely. People will build solutions on top. And certainly if you look at people like Robinhood right now, they're trying to build tokenized solutions for both public and private assets. And I'm kind of trying to work out how the risk will work on that, because essentially the tokens will not be, they'll evidence another security. So there'll be essentially a derivative product, a bit like a depository receipt is a derivative of the ordinary share underlying it. I'll be interested to see how they can actually work with the risk on that. But certainly I think within a few years we will see tokenization, essentially instant settlement of these kind of deals. And obviously the cost will be massively reduced because of
It's
that.
already happening now with DTCC and their T-Rex Ethereum protocol.
Yep.
In addition to that, NASDAQ just made a filing
Yeah.
where they're tokenizing their entire exchange for the most part. So you're starting to see the world go there, and everyone's going to follow suit. We found out that the ex-CCO of Drywall Blaugrund just went back to ICE on a top secret mission on the digitization side. So should be a fun future ahead of us. But I have a question. So going back to the globalization, so raising capital globally sounds like a great idea, right? Our administration right now is kind of hampering that in some way, right? So the risk there, I think, is always going to be in the back of someone's mind, right? So how do you thwart that?
Oh, I'd say that regional geographic regulatory uncertainty drives more internationalization. I mean, do you want to be dependent on one country's rule for how you get your capital, or do you want to be in multiple countries? And I think there was a clause of the big beautiful bill that ended up not becoming law that was going to do withholding for Canadian investors, including pensions. So we decided to threaten to essentially say, don't invest in the U.S. And the Canadians, I've talked to the pension funds, they're like, we want to invest, we like the company, but we want to do it through London because we don't want to wake up one day and discover, our stock is being repossessed by the government, right? Now, whether that's a real concern or not, I don't know, but they're thinking about it. So I think that uncertainty helps drive a more global perspective on capital markets.
And so what I would say about that is it's quite interesting. I mean, we're talking about IPOs, we can also talk about dual listings or secondary listings. Since the tariff kind of noise started happening, we've had a lot more inquiries from US-listed companies with international assets that say, maybe I should have a secondary listing outside because the investor base in, say, the UK, Australia, or Canada will be interested in me, and it makes sense for me to diversify my investor base geographically. And the best way to do that is by having a secondary listings, because most investors work on mandates. So in the UK, the biggest institutional investor pool is the one with a UK mandate. So they don't care where the company's from, it just needs to have a UK listing on a UK exchange. So, and there's lots of US domestic equity funds which have exactly the same issue. The company needs to be listed on a US exchange for them to invest in it, and that's the biggest pool of capital in the US.
So a question about the LSEG, right? So I worked at ICE before, and I know NASDAQ's business model. On the listings market, so you're the primary listing market. Is there any talks about working with like the Geminis of the world or the Krakens of the world and getting your listings on, those type of exchanges and doing deals with them to make the listings a little bit more widespread?
Well, I think yes, there's definitely those conversations going on, and as part of the transition to a true digital infrastructure, I think that is going to happen. But where the issue really comes, the friction comes in, is from a regulatory perspective. Now, if you want to sell to US investors, you need to have an applicable safe harbour to use. Now, for a London IPO, that's usually 1448 equips. Okay? You cannot sell to retail in the US if you're doing a London-listed IPO. The only way you can is if you also list that company in the US at the same time, so it's an SEC registry. That's the only way you can do it. So there are all of these roadblocks that are in place. So you can say crypto's great and all this stuff, but it needs to fit with the regulation. The weird thing is crypto is a strange thing because it's almost gone. People didn't know where to put it, so they haven't really regulated to it. So the one thing that people in, say, the UK and in the US can almost own equally is pick a coin. You can own that. You can own that. Even if the person behind it is in the US, the people in the UK can still own it, but not a company, unfortunately. The regulation stands in the way of that.
So you can buy Microsoft tokens right now if you're not a U.S. citizen, and they're 100% collateralized by shares of Microsoft stock. Mm-hmm. So you essentially, the Stablecoin Act and framework is moving to securities. So I think you're gonna see that, and I think we can learn a lot from what happened with the futures market. It's eating into gambling because they essentially said,
yes,
wait, we have an infrastructure that supports these contracts, and people are trading these contracts, and it's not just predictions on financial outcomes. Now it's anything you can think of, and Robinhood is putting it on their app. So I think you're going to see sort of a blockchain is going to cause a convergence of financial instruments globally.
So does that mean you will have a global exchange at some point?
I'm sorry?
A global exchange?
I think you have a cloud where you say, I want to buy this, and your order gets filled. So,
like Amazon, basically.
Yeah.
Yeah.
Well, different question. One is, so what happens to all these stocks that were on OTC markets, and there was that, they kept telling you, well, you start here, and then you're going to go all the way, you're going to start in OTC markets, and then you're going to go to NASDAQ, whatever, and it's almost like high school, college, and then you graduate. So what happens to all of those?
Well, I think going back years ago, the NASDAQ used to say, hey, list here, and then when you're a real company, you can go to the New York Stock Exchange.
Right.
And what's happened is the NASDAQ and the New York Stock Exchange has essentially converged on mega cap companies, and the trading has moved into all these trading venues. I think The NASDAQ is the biggest trading venue for NASDAQ stocks, and they have something like 30% of the trade volume. So I think if you're not a mega cap company, you can still look at listing and saying, oh, I may go to NASDAQ or New York Stock Exchange down the road. I just wouldn't do it in the U.S. You're going to have just directors and officers insurance is hundreds of thousands of dollars. Your chance of litigation is like 1 in 5. How many, in London, how many lawsuits were there, shareholder lawsuits?
There were, I think it was 5 in the last 15 years. And the US last year was 228 in a single year. So that shows you how different it is. And obviously your insurance is going to cost you a lot more if you're getting sued all the time versus the UK where it doesn't happen so often. But actually just that, the microcap thing is really interesting actually, because I think on OTC, most US mainstream brokers will not touch OTC. Because essentially they think, pink sheets and all this kind of
Oh,
stuff.
QX, they'll do QX.
Yeah, but
There's billion-dollar companies from QX,
there are.
multi-billion.
QBQX, yeah.
But
But I agree. Pink sheets, no.
yeah, but what I'm saying is that there'll be a question people will ask if you're on, QX. They'll say, well, why aren't you on Nasdaq at that level as well? And also at $1 billion, you would be not even at the low. You'd be not on the Nasdaq capital market. You'd be in one of the higher tiers of Nasdaq. So people would ask why you're not doing that. But going back to Nasdaq Capital Market, which is the lowest tier of Nasdaq, there's been a number of changes recently because they did have a glut of IPOs in the last 18 months. The median offering size was something $8 million of these deals, and they traded horribly. And then, so a couple of things were introduced. They increased the minimum offer size on Nasdaq Capital Market to $15 million. And then last month, for Chinese companies where the majority of their exposure is to China, they increased it to $25 million for minimum offer size. And if you look at how many IPOs that would have cancelled out from the last 18 months, something like half of the deals in the sub $25 million range with those companies. So it would cut your number of IPOs in half.
Yeah, and for a foreign company to list in the U.S., it's a different regulatory hurdle. So, an F1 as opposed to an S1.
Yes. But I think the issue is we've had numbers in these companies essentially that raise tiny amounts of money and then they kind of get stuck.
Yeah.
But there are a number of advisors who are happy to take the fee, to be honest.
We'll take our fee.
Yeah.
Thanks.
I just want to circle back to the question about the globalization of capital markets. I think if we look at currency, at some point relatively recently, we weaponized the SWIFT currency exchange system. We decided when Russia invaded, we decided, we're just going to, we're going to keep these assets. And if you're in another part of the world and all of a sudden the countries start taking your bank holdings, it affects where you keep your cash and how you keep your cash. The same thing can happen in equities. Right? We wake up and say, there's a sanction now. We're keeping this equity. Right? So I think investors are starting to think about where their stocks are and how they're being traded. And it's not, we're not in a world where it's just, we're all get along and it's up in the cloud somewhere. You actually have to think about it.
One thing the United States always championed was property rights. Right, so there was only one other time, I guess, in our history where we did expropriate assets like that. That was during World War II with the Germans. But what we've done with the Russians now, that's a problem. Weaponizing the dollar, it's going to discourage people from holding dollars and dollar-denominated assets. It's not a good thing.
And also global fiat currencies in general, because a lot of these second, third world countries who don't have laws that we do for like cryptocurrencies, they get money transferred from other parts of the world and they just hold it in their wallet and they trade Bitcoin or they trade other cryptocurrencies. And the youth, part of the problem that I see with the IPOs in general is that the holding period with the youth, it doesn't align anymore. They're very fast. They want something done quick. Everyone wants something done quick. And you get, your day traders, but also a spectrum, people do want to hold, people do want to invest, and they'll invest for the long term. But traditionally, any IPO that I've been involved with, right after it came out, the thing tanked. Okay, so it puts a little bad taste in people's mouths. So I think there's probably a lot of reform on the table that we can all think about. But probably now's a good time. We have a lenient government right now in this country, and so the LSE group could probably lobby here pretty hard. Talk to Jeff Sprecher about that. They do a great job at ICE.
But I have to say that I'm always, when I say a company goes and does an IPO in the UK from the US, most of that capital gets reinvested in the US. I'm always at pains to make that point, because if people really want to be nationalistic, we're helping create US jobs with these IPOs. We're helping companies who can't get access to capital with this particular profile access capital and invest mostly in the US. And so it's really a win-win for all of us. But to your point, what the President came out and said on Monday, we agree, actually. We think that half-yearly reporting is better because it encourages longer-term thinking and it reduces cost. I know there's going to be some market participants who won't like it. So I think it'll be a very hard slog to get people to move. And even if I said this to Jeff before, even if they remove the quarterly mandate, I think it'll still be very hard to stop companies from actually reporting quarterly.
From a disclosure standpoint, I like a lot of the international markets have continuous disclosure, and I'm a lean process person. I like big fan of Denning, and this idea of let's keep information bundled up and send it out in batches, I just think is not as good for the market. So I'd like to see us move to more of a continuous disclosure regimen.
So the way the UK works is, even though we only have half-yearly reporting, if there's been a material change to your business, then you have an obligation to report it, even if it's in between reporting cycle, because the market needs to know or have the up-to-date information to make an informed investment decision. So it's actually an EU law called the Market Abuse Regulation that still applies to the UK as well, which really says that when you become aware that the operating or some other thing about your company is completely out of step with what is in the market and what the expectations are, then you need to update the market.
I agree with both of you, Jeff. One of the things that I'm a data scientist, and amongst other ridiculous things in AI, but the fact that if a continuous sort of reporting mechanism, and something that's transparent in terms of when those events will happen, is great. It adds a whole new data stream to the market as opposed to playing guessing games for the investor. At least they can make a decision on whether they want to participate or not, or short a position or go long and whatnot.
I have a question on price discovery then, based on what he's saying. If you look at the pre-IPO, these companies are not providing liquidity. An investor wants, of course, liquidity and the return of capital, but the return on capital. If you look at the 50 to 2 billion, as you said, versus the higher end of the market, is there much difference in price discovery in that smaller group versus the larger caps?
So I think one of the big differences is in the U.S. we've locked down our quiet period. So we have very inefficient price discovery at the IPO. And 144 basically, I don't want to know something. I want to be able to trade if I buy at the IPO. In these other countries, they'll have extended pre-IPO rounds where you're building relationships with institutions. They're setting the price, or they're setting a cap. They're buying at a discount to the IPO. But that means when you go public, they could sell that day. Their securities might convert into part of the public float. But it creates an orientation, like a dating period. You'd never show up to your wedding and meet your bride for the first time, but yet that's how our IPOs work.
There's a TV show for that. What are you talking about?
There you go.
I'd like to rewind to something that you two were talking about earlier on, which I think is really important. And I want to give a real-life analogy to the other part of the audience from Maine, which are money management firm owners. So money management firm owners that are domestic, they start a business here, they start running, they get to whatever size they're at. At some point, they start to think, should I go overseas and take my product or variation of it and offer it in the UK, in Western Europe, in Australia? So there are certainly enough law firms around saying, well, we could sign documentation. At the end of the day, you could be doing UCITS if you want to do that. I remember the day when at the Britain's mission to the UN had a day for small and mid-sized hedge fund firm owners. And they're having everybody come in saying, Britain is your jumping off point. Open an office in London, in Cardiff, in Edinburgh. We're here to talk to you about how we're going to support you. So you're going to open up your business here and be able to have a branch and then sell to a new market. They got no players that followed through, because one of the problems is the money management firm owner goes, now what do I have to do this? I'm going to have to hire a new staff, the equivalent of IR. I'm now going after a different market. How do I figure and target? So here, there are companies that need to be able to have liquidity, and they want to be publicly traded, but to go do it and say, I register wherever, but now I'm going after the sovereign wealth funds in Australia, for example. What's the skill set we need, and who's going to help teach us? Because this is workflow and process stuff that none of these companies who paperwork-wise could do this actually know what to do. Has the LSE been doing things behind the scenes to help firm owners, whether it's a manufacturing business, digital? Can you talk to us about that?
I think that's like there is the, what do I need to change to be able to be listed in the UK is what people ask about. So you don't need to change incorporation. We have a lot of Delaware incorporated companies that go public in Nevada and Florida. Don't need to change incorporation. Don't need to change US GAAP if that's what you're using. You can choose to use IFRS, but we accept US GAAP. You don't need to change your governance. You don't need to be subject to the UK Takeover Code. You don't need to have an office in the UK. You don't need to have an employee in the UK. You don't need to have any revenue in the UK.
And it's tax-free. Right?
There's no tax implications through the listing, by the way. So it's not like you're subject to UK tax as a result of either corporation or personal tax.
No step tax for every organization that does this.
There's no stamp tax on AIM.
They're then having to create a new subset in their business because they now need a specialist to be able to go after, to find Bob and then develop the IR relationship.
Well, here's the thing. So the UK, part of my job is actually connecting people to the right advisors to help them. In the UK, there's a concept of what's called the corporate broker, where in the US, your investment bank does your deal, takes the fee, and then says, okay, our research analysts may cover you, but that's independent, so I hope they do. I hope they continue to do that. In the UK, the investment bank will do your deal. By the way, to Jeff's point before, in the UK, doing testing the waters is much more flexible than it is around a US IPO. So you will meet investors 3 to 4 times before you even go on a proper IPO roadshow. And the cost of doing that, at least at the start, is minimal because you don't have to have a draft registration statement in place. You can just take a presentation you've had a lawyer look at. That's all you need. So it's really flexible to do that. You develop the relationships. You'll do that with an investment bank or investment banks. Now, after the IPO, the investment bank will become what's your corporate broker. They'll be your eyes and ears in the market. They'll be talking to your investors every single day. They'll be publishing research on you. They'll be giving you insight into who's trading your stock. They will be your person in the market on a daily basis, and you pay them a retainer, usually $75,000 a year retainer to do that. And they'll publish research, and then if you do a deal, an equity offering, they'll be on the deal. So to your point, you'll have someone who will be supporting you all the way through. Now, you may choose to put an IR person in London because you've got a very large UK and European investor base. You might choose to do that, but I've known lots of companies who didn't need to do that because they were getting the support with the investment bank, because you get that on an ongoing basis in the UK. Here that doesn't happen. You actually have to hire third-party IR support.
Or you're hiring internal.
Yeah, but you probably have both actually.
Right. So for a lot of companies that are doing this, this is a brand new thing.
Yeah.
Whether they'd be doing it in the U.S. or
Yes.
focusing it elsewhere. Getting that part right is the issue. I'll ask the last statistics question.
Yes.
We remember we were at it was a County Trade Association. I'm going back maybe 12 years, and this was about the liquidity crisis of what happened. That there'd be the IPO, everything goes up, pause, wait, boom. The share price drops, and the number of share prices that drop and never rebound. It's this many, not that many. What's been reality going on in London?
You should look at my LinkedIn because I write about IPO pop a lot. IPO pop does not happen in the UK and Europe. A couple of reasons. Price discovery, more testing the waters, so more ability to create relationships with investors. We still have deal research in the UK around IPOs, so that was outlawed in 2004 in the US. Elliot Spitzer, if you remember him, got it outlawed and made the banks pay a huge settlement. So you can't do IPO research on US IPOs. In the UK, you do. So the banks on the deal will send a research report to their main institutional clients and saying, this is the company, here's our model, come back to us. And then the analysts go and see all of the major institutions. And at the end of that, they gather feedback on valuation, and that's what you use to set the price range in the UK and Europe. And as a result, 90% of deals in the UK and Europe price within the initial price range. In the US, it's less than 50% because you have no mechanism to really get good feedback from investors anymore prior to the IPO process. And as a result, IPO, the median IPO increase since 2020 in the UK, I think, is 5% on the offer price.
But large investors like IPO pop. That's my understanding.
Yeah, but those are not the long-term investors. Those are insiders who are going to flip.
But there's a lot of them, and they got deep pockets, right?
Sure, but also the green shoe. We have more green shoes in the U.S. It's named after the green shoe company that went public in the U.S. We have more green shoes than anywhere else in the world, and we have more mispriced IPOs.
Yeah.
And my banker says that bankers are not greedy, and that is complete coincidence.
So, by the way, I agree with it. And just think about what's happening. This doesn't happen in the UK, and also we have larger free floats. I need to be clear on that.
Yeah.
So we tend towards larger free floats and larger secondary components in the IPO.
Yeah.
Because the investor base is fine with that, and actually that's a good thing from a liquidity perspective. But think about, I'll take an example, think about Figma. So they did all of this marketing, blah, 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 and then the price range was moved up multiple times, and it got priced at $33 a share. And then, the investment banks and they say, we allocated mostly to long-only investors, high quality book. They said all this stuff. First trade is at $85. Imagine you are, and this is a very peculiarly US thing. Okay, it happens in a couple of markets, but not the UK and Europe. So imagine you're an institutional investor, even a really high quality long only. You did all the work on the Figma IPO, and it priced at 33, and you were happy to buy at that point. How many of those investors in there, and they would have done, they have to back up what they're doing and what they're investing in, they would have done the analysis. How many of them do you think would have had it worth $85 a share?
I don't know, but I think they'd be happy to sell half their allocation right there.
They'd have to.
Take the profits, yeah.
If their internal work says this is worth $50 a share, and therefore I'm happy to buy at 33, if it goes to 85, you almost have an obligation, a fiduciary obligation to sell it. But what I would also say is, there's a lot of noise around this because you can say, this is a lot of this you could say is a way for banks to almost, and I'm not sure, I don't know any of this for sure, but if you allocate to an investor and then they're able to sell for 100% immediate return. It's almost essentially it's like rebating their trading
Yeah,
commissions.
you've made a great client right there, because I used to work at a big bank, and that's what they love. And I think that speaks to the depth of the capital pockets in America. But I don't know.
The other thing is the U.S. IPO market is giving allocation to people who are using leverage, because those are the profitable bank customers, and they're flipping it, and that's great for the banks, and it's great for the capital that participates for a little period of time. But family offices are not part of that.
Yeah.
You go to other parts of the world, and family offices, I mean, they're going to be about $10 trillion of debt, of assets, I think, crossing this year or next year. I mean, there's a lot of money there, and the banking system here doesn't target them. In other markets, you see they're an important part of the IPO process.
So,
Sorry, can I just jump? Oh, so go ahead.
just one last
Yeah,
thing on
yeah.
this, I think it's important. So, retail is the other thing. In a few actually recent IPOs, especially the crypto ones, they have allocated quite a lot to retail, which is interesting. In most IPOs, actually, there's certainly the Figmas of this world, they don't. So you have a huge unmet there's unmet demand, there's tight free flow, people chase. So Figma went up to $140 in the first 2 days. That's retail chasing that, basically trying to get some, because they got no allocation in the IPO.
The
So I
meme
think,
stock mentality.
yeah, exactly. So I think having met in this day and age with the technology you have, you can surely get some form of idea of what retail demand is for the IPO and allocate a reasonable amount to retail to dampen down that kind of
But big banks
frenzy.
don't care about retail, because they want the big customers.
Well, this is the.
I get
This
it.
is,
Exactly,
this,
exactly.
Basically, if I was a company, I would be asking these questions of the banks.
Yeah.
The other question I would ask, the last thing I'm going to say, is when you do an allocation discussion, and VCs and companies obviously part of this, the banks will say, oh, it's a kind of a black box, but you should go through and say, let's look at the allocation you've given to all these people. Did I meet this person on the roadshow? Why? Okay, no, I didn't. They've shown no engagement. Why are you allocating so much stock to this person? And it's the answer often is because they're a big client of the firm,
Exactly.
and that's not a good answer.
Yeah.
And people aren't being stringent enough, and actually they say, you know what, we'll get the big pop, we'll get the good headlines, we'll think about that later.
So I just want to jump in, sorry, and kind of bring our discussion back to where we started, which is kind of providing exits for those VC firms that first believed in the company, right, and invested in the early round and now can't wait, for an exit. So if a company were to list their shares on the London Stock Exchange, an IPO is a primary issuance of shares. That's like additional shares that the company is issuing and selling. But what about the shares that are already held by...
That's where we come in.
Yes. So
'Cause
can they be also listed and
Yes.
become
It's even
liquid?
better.
Okay.
They could sell 3 days before the IPO,
Oh,
or a week before the IPO.
that's interesting.
They could sell at the IPO.
So they can participate, fully participate. So it is a true exit in a sense.
So one of the things we try to do is as a company approaches an international public offering, is we go through the cap table and say, who can we buy shares from at a discount? Because they're going to apply selling pressure when it goes public, and there's so little liquidity in the U.S. they're willing to sell it at a discount. So it's a great opportunity. Because I don't know, Australia, Canada, that seems like such an exotic place. I don't know about a Canadian IPO. I better sell now. So this idea that you have to be locked up for 180 days is a legacy of the 1930s that a lot of people haven't realized is not necessarily the way it needs to work.
Amazing. Mm-hmm.
So I'd say if you look at the stats, London IPOs, even for tech companies, have much higher secondary components as a proportion of the deal. So we are enabling incumbent investors to take money off the table at the point of IPO, as long as they still have some skin in the game. Because obviously it would be a huge red flag if they were like, I want to sell like 90% of my holding. But we've had deals for tech companies where half the deal has been secondary.
Mm-hmm.
So it is possible to do it at the point of IPO.
Yeah. Well, that's great. I'm almost sold. And I'm almost out of time, right?
Yeah, so Jeff, a pretty fundamental question. I have my company. I am price. I go with my high price bankers. I'm pricing it at 33, and the next thing is, 85, okay, wherever it's opening, okay, there, almost triple, okay, regarding that. I've just sold my company effectively right to the public at 33.
Yeah.
Why am I happy? I understand market caps and how they work, okay, regarding that, but why am I, and secondary offerings, pricing, but why am I happy that I just sold my company at 33?
The only reason that I could see that you might be happy is the marketing value that you get by being so mispriced is more valuable than the cash. But for me, I would just rather, go buy TV ads for that.
Considering my company, okay, has been sold for 1/3 of what the world is paying for it, okay, regarding that there, and other people are getting that value. So.
Yeah, I think mispriced IPOs are a hugely underappreciated cost of going public.
I agree.
And they're not necessary. We've seen in other parts of the world that the world doesn't have to work that way.
And while I have the floor, another quick question. You were talking about continuous disclosure versus the current administration going obviously to like London, okay, twice yearly.
Yeah.
Why doesn't the 8K process solve that? Just like in London, we have an 8K. We have to file for material events, so that happens at any time, okay, regarding that. Why do you need to be tied into every 90? Why do we have to be tied into every 90 days?
So I think, again...
You're getting an 8K, right, again?
Yeah, I think that the quarterly...
We're not changing the 8K. I don't think there's a
Yeah.
proposal to change the 8K.
Yeah.
Right.
No, I think the quarterly is a legacy of rules that are decades old. And again, we look abroad and we say, is this best practices globally? And I don't think it is.
Okay. You finish the 8K. You finish the quarterly process. You're getting ready for the next. You're getting ready, right? You're into the next quarterly process.
We have companies where the earnings call is pre-recorded. Okay, and there's $10,000 worth of lawyers looking at it, like for every 20 minutes of. So why would you want to listen to that call? There's nothing interesting is going to come out of that call. So I think that you used to be able to just go talk to CEOs, and somehow markets work better then. You used to be able to have research, and some genius Spitzer said, "Hey, wouldn't it be great if we had less research because that'll better serve investors." There are lots and lots of banks globally that weren't signatories of the Spitzer settlement.
All right, well, we're going to end it there.
Andrew.
I have one last question, if that's okay. It's sort of price discovery and private equity secondaries. As I understand it, they trade at around 60, 70 cents on the dollar. I'm just wondering with what, I think you mentioned that maybe there's some secondary mechanisms, exchanges. Is that going to tighten that? Because that just seems like with a $17 trillion market, it always seems weird to me that secondaries trade at 60 cents on the dollar. So I've never been able to square that circle. So I was wondering if you could talk about why are they trading at 60 cents on the dollar in a $17 trillion market, and will these mechanisms tighten that up a bit?
So I think the secondary markets are getting more efficient. It used to be there were essentially a secondary market for like 3 companies, and it became 8. Now it's a couple. It was a pretty good market for about 100 companies. But you get to smaller companies, you can get substantial discount. I think one of the reasons for the discount is lack of transparency. You don't have good information disclosure, and why is that person selling? What do they know you don't know? And then a lot of those, it's a discount. Well, you're actually not getting shares. You're getting an SPV that is supposed to get some Series B stock, which has $2 billion of preference on top of it. So and you don't even have the stock. That stock is subject to a ROFR. So conceivably, you may end up not getting that stock. And did they sell it twice? I mean, I guarantee you, there's some SPVs out there that have pledged stock that they're never going to get that stock. So
And also SPVs have fees. Don't forget management fees and other fees.
It depends on the structure, where they are in their cycle. But if you're involved in any sort of pre-revenue or in the cost per revenue situation, the visibility in terms of the sales and the goodness of the financials in terms of their audit, a lot of factors that you kind of think of it from a public market's point of view, but you have to take a few steps back and look at the quality of what you're really acquiring. And I think that affects the valuation.
Couple of things to say there. Discount to what? Because there's a couple of things to say. Last round for this company may have been a number of years ago, so the mark may not be at all realistic given what's happened to valuations in that time or what's happened to the company. The other thing to say is what class of share are you selling? Where is it in the preference stack? Does it have rights attached to it which are valuable, liquidation preference, things like that, versus common shares, which common shares usually will trade at a discount to preference shares because they have no additional rights attached to them, so they are inherently less valuable, and most employees will be owning common shares. So there are those things to think about. But even saying all that, the platform we're launching is different in that it uses our auction technology. So people will be putting bids into the electronic system, and it runs like our opening auction for the public market. So you should have better price discovery and better price outcomes because you have more investors are basically just coming in and putting in their bids. We've standardized the packet of information that you need to put. It's based on private company disclosure, not public company disclosure. So each investor that's putting their bid into the auction system will be looking at the same information. Right. So that's part of the problem now is you have a lot of people bidding on secondaries here in the US who are doing it with no information. Because they're perhaps buying from someone who has no information rights, and they're saying, I want to sell this secondary stock. I say, okay, I know, I'll buy it for a 40% discount because there's no information rights. So they'll have literally no idea how the company is doing.
I just wonder, and sorry, last thing I'll say is, I don't invest in private equity, but if I did, I would be a little bit worried that you do get marks, then is that mark just complete BS if I want to sell my LP share and I'm going to get 60 cents on the dollar? Shouldn't I be worried?
I only trust a mark which is continuous and public.
Got it. There you go.
Because I've been in these meetings with these NAV people, and what's this asset worth? And in the morning, I'm like, oh, that's a $2 billion asset. And, ask the next expert 2 hours later. Oh no, that's a $1 billion. Say, well, what about this? Oh yeah, you're right. It's $3 billion. And people are being compensated off these bullshit numbers. I like things that move into the public market.
Part of 90. Show me a NAV markdown that's gone from part of 90.
Yeah.
Hybrid global debt.
And the CEO of Blue Owl the other day said,
I'm saying when NAV goes from part of 90, it's not very often. It's usually part of something a lot
lower.
So it's the last thing to say, and that's quite interesting. We have a number of listed private equity vehicles in the UK. So their underlying assets are venture investments. And since 2021 to today, a lot of those investments have not had any changes, any rounds to really mark them. But because these are public equities, evidencing the underlying private, they trade at like 30 to 40% discount to NAV because the market is telling you, we know those marks from 2021 are no longer accurate. And that's what happens when you have closed-end vehicles. They trade at a discount to NAV.
Everyone on the board is incentivized to keep that as possible.
But if you've got a public vehicle, you can't.
They're trying to do ETFs like that too.
Yeah. But ETFs have mechanisms to obviously tighten that up.
Yeah.
But we're talking about old-fashioned closed-end investment funds in the UK.
Okay.